They told you trading was about strategy. They lied. Because if strategy was enough, you wouldn't have blown your account. The market didn't destroy you, your emotions did. And until you understand why you keep sabotaging yourself, you will repeat the same painful cycle again and again and again. Every trader remembers the moment the account hit zero. The moment you stared at the screen in silence, sick to your stomach, asking yourself, how did I let this happen? I know that feeling. Not from a book, not from theory, from experience. Blowing an account is humiliating. It crushes your confidence. It makes you question your intelligence, your discipline, even your future as a trader. But here's the truth nobody tells you. The traders who survive this moment are the ones who eventually become dangerous in the market. Because pain teaches lessons profits never will. In this speech, we are going to talk about why traders blow accounts, the psychological traps that destroy consistency, and how you can rebuild yourself into a trader who no longer trades from fear, revenge, or desperation. This is not motivational nonsense. This is reality. And if you truly listen, this could be the turning point of your trading career. Most traders do not blow their accounts because they lack intelligence. They blow them because they underestimate the emotional pressure that comes with risking money. Trading looks simple from the outside. You buy, you sell, and if you are right, you make money. But once real money is involved, logic disappears faster than most people can imagine. Fear enters the mind. Greed takes control. Ego becomes involved. And suddenly, a good setup is no longer enough to save you from yourself. The biggest mistake traders make is believing they need a better strategy when the real problem is usually their behavior. A trader can have an excellent system and still lose everything because they refuse to follow rules consistently. They increase position sizes after a loss because they want their money back quickly. They move stop losses because they cannot emotionally accept being wrong. They overtrade because they are addicted to the excitement of the market. These habits slowly destroy accounts, not because the market is unfair, but because emotions are stronger than discipline for most people. Another reason traders blow accounts is unrealistic expectations. Social media has convinced people that trading is a fast road to freedom and wealth. New traders enter the market believing they can double an account in weeks. That mindset immediately creates dangerous behavior. Instead of protecting capital, they chase huge profits. Instead of thinking long-term, they gamble for short-term excitement. They risk too much on a single trade because they believe one big win will change their lives. The problem is that the market punishes desperation. The more emotionally attached you are to making money quickly, the more likely you are to make reckless decisions. Ego also plays a massive role in destroying trading accounts. Many traders cannot accept being wrong. They treat losses like personal failures instead of normal business expenses. So instead of cutting a losing trade early, they hold and hope. Hope becomes their strategy. A small loss turns into a disaster because the trader refuses to admit the trade was wrong. Professional traders understand that losses are part of the game. Amateurs fight the market because they want to protect their pride. There is also the issue of inconsistency. Most traders are disciplined when things are going well, but discipline disappears during stress. One bad day becomes two become five. Then the trader abandons the plan completely. They start switching strategies, chasing indicators, copying other traders, and making emotional decisions based on panic. At that point, trading becomes chaos instead of a structured process. The truth is brutal but necessary. The market does not care about your needs, your bills, or your emotions. It rewards discipline and punishes emotional weakness. Most traders blow accounts because they never truly prepare for the psychological battle of trading. They focus entirely on entries and ignore mindset, risk management, patience, and emotional control. Blowing an account is painful, but it exposes the truth. It forces you to confront your weaknesses. And sometimes, losing everything is the moment a trader finally understands that success in trading is not about predicting the market. It is about learning to control yourself when money and emotions are on the line. Revenge trading is one of the fastest ways to destroy a trading account because it completely removes logic from decision-making. The moment a trader becomes emotionally attached to recovering losses, the market stops being a place of opportunity and becomes a battlefield driven by frustration, anger, and desperation. That is where discipline disappears and self-destruction begins. Every trader knows the feeling. You take a loss and suddenly your mind is no longer calm. Your heart beats faster. You stare at the chart searching for another trade, not because the setup is good, but because you need to win back what you lost. The focus shifts from following a process to satisfying emotion. That is the beginning of revenge trading. The dangerous part is that revenge trading often feels justified in the moment. Traders convince themselves they are making the money back or correcting a mistake. But emotionally charged trades are usually impulsive, oversized, and poorly planned. A trader who normally risks 1% suddenly risks 5 or 10% because they feel pressure to recover quickly. Instead of waiting patiently, they force trades that do not meet their rules. One bad decision leads to another, and losses begin to multiply rapidly. What makes revenge trading so destructive is the psychological spiral it creates. The more money a trader loses, the stronger the emotional need becomes to recover it immediately. That pressure clouds judgment. The trader becomes obsessed with winning rather than trading well. And when emotions take control, discipline becomes impossible. Many traders believe the problem is the market, but the real problem is emotional instability. The market did not force the trader to increase risk. The market did not force impulsive entries. Those decisions came from fear and frustration. Revenge trading exposes a trader's inability to accept loss. Most people enter trading expecting to win constantly, so when losses happen, they take them personally. Instead of accepting the loss and moving on, they fight the market emotionally. Professional traders understand something amateurs refuse to accept: losses are normal. They are part of the business. A professional can take several losses in a row and still remain emotionally stable because they know one trade does not define them. Amateur traders, however, attach their self-worth to every outcome. A losing trade feels like failure, and that emotional pain creates the urge to immediately fix the situation. Another dangerous aspect of revenge trading is exhaustion. Emotional trading drains mental energy very quickly. After a series of impulsive trades, the trader becomes mentally tired and even less capable of making rational decisions. Mistakes increase. Patience disappears completely. At that point, trading becomes gambling disguised as analysis. The solution to revenge trading is not finding a magical strategy. It is learning emotional control and risk management. Great traders know when to stop. They understand that protecting capital and protecting mental stability are equally important. Sometimes the best trade is no trade at all. Walking away after a loss requires more strength than forcing another position out of anger. The market will always offer another opportunity tomorrow. But revenge trading makes traders act as though every loss must be recovered immediately. That mindset destroys accounts because it replaces patience with panic. In the end, revenge trading is not really about money. It is about ego, emotional weakness, and the inability to accept temporary pain. And until a trader learns to control those emotions, the cycle will continue repeating itself. Fear and greed are the two emotions that control almost every trader, whether they admit it or not. The market is not just a financial battlefield, it is an emotional battlefield. Every decision you make while trading is influenced by pressure, uncertainty, hope, anxiety, or excitement. And if you cannot control those emotions, they will control you. Fear appears in many forms. Sometimes it shows up before you even enter a trade. You hesitate because you are afraid of losing money again. You see the setup clearly, but your mind remembers previous losses, so you avoid taking the trade. Then the market moves exactly as you expected, and frustration begins building inside you. Other times, fear appears after entering a trade. The moment the market moves slightly against you, panic takes over. You close the trade too early, even though your original plan was still valid. Instead of trusting the process, you react emotionally because you are trying to avoid pain. The problem with fear is that it destroys consistency. A fearful trader cannot follow rules properly because emotions constantly interfere with decision-making. One moment they hesitate. The next moment they panic. Then they become frustrated for missing opportunities. Eventually, fear turns trading into emotional chaos rather than structured execution. Greed is equally dangerous, but it often hides behind confidence. Greed makes traders believe they can always make more money. A trader enters a profitable position, but instead of taking planned profits, they become obsessed with squeezing every last dollar from the move. They ignore warning signs because greed convinces them the market will continue forever in their favor. Then the market reverses, profits disappear, and what was once a winning trade becomes a painful loss. Greed also pushes traders to risk too much. Instead of protecting capital, they become addicted to the possibility of fast money. One winning trade creates overconfidence. The trader starts increasing position sizes recklessly because they feel invincible. That emotional high is extremely dangerous because confidence without discipline quickly becomes arrogance. And the market has a brutal way of punishing arrogance. One of the biggest psychological traps in trading is that fear and greed constantly feed each other. After a big loss, fear dominates. After a big win, greed takes control. Traders swing emotionally between panic and overconfidence, rarely operating from a calm and balanced mindset. This emotional instability creates inconsistency, and inconsistency destroys long-term success. Social media makes this even worse. Traders constantly compare themselves to others, showing huge profits, luxury lifestyles, and unrealistic returns. That comparison creates greed and impatience. People begin trading with desperation instead of professionalism. They stop thinking about survival and start chasing excitement. But trading is not about excitement. The moment you trade for emotional stimulation, you become vulnerable to emotional decisions. Professional traders understand that emotional control is more important than predicting the market. They know fear will always exist. They know greed will always tempt them. The difference is that professionals do not allow emotions to make decisions for them. They rely on structure, risk management, and discipline because they understand that emotions cannot be trusted under pressure. The market constantly tests your psychology. It exposes impatience, insecurity, ego, and emotional weakness. That is why trading is so difficult. You are not only fighting the market, you are fighting yourself. And the traders who survive are not necessarily the smartest people in the room. They are the people who learn to remain calm while everyone else is controlled by fear and greed. Most traders enter the market believing success comes from finding the perfect strategy, but the truth is far less exciting. Long-term survival in trading depends more on risk management and discipline than on predicting market direction. A trader can be wrong many times and still make money if risk is controlled properly. But even a trader with a strong strategy can destroy an account quickly if discipline disappears. Risk management is what keeps traders alive during difficult periods. The market is unpredictable, no matter how experienced you are. Losses are unavoidable. There is no strategy in the world that wins all the time. Professional traders understand this reality, which is why they focus first on protecting capital. They know that survival is the priority. If your account survives, you can always recover. But once the account is destroyed, the opportunity to improve disappears with it. The biggest mistake inexperienced traders make is risking too much on single trades. They become emotionally attached to one idea and convince themselves they are certain about the outcome. That confidence leads to oversized positions, and oversized positions create emotional instability. Suddenly, every small movement in the market feels painful. Fear increases, panic increases, rational thinking disappears. The trader is no longer calmly executing a plan. They are emotionally reacting to money fluctuations. Small risk creates emotional stability. When risk is controlled, traders think more clearly because they are no longer terrified of losing everything. They can accept losses without emotional breakdowns. They can follow their system consistently because one trade no longer feels life-changing. This is exactly why professional traders survive while amateurs collapse. Professionals understand that trading is a marathon, not a sprint. Discipline is what allows risk management to actually work. Many traders know the rules but fail to follow them under pressure. They set stop losses and then move them when the trade goes against them. They promise themselves they will only risk a small amount, but emotions convince them to increase position sizes after losses. In calm moments, discipline feels easy. The real challenge appears when fear, greed, and frustration enter the mind. The market constantly tempts traders to abandon discipline. After a losing streak, traders feel pressure to recover quickly. After a winning streak, overconfidence appears. Both situations are dangerous because emotional traders stop following structure. They begin acting impulsively instead of professionally. True discipline means following your process regardless of emotions. It means accepting losses without revenge trading. It means waiting patiently for quality setups instead of forcing trades out of boredom. It means understanding that consistency matters more than excitement. Most people want the rewards of trading without accepting the responsibility that comes with it. They want freedom and profits, but they resist patience, structure, and emotional control. Risk management also protects traders psychologically. Massive losses damage confidence and create emotional scars that affect future decisions. A trader who blows half an account becomes fearful and unstable. They hesitate on good setups. They panic during normal drawdowns. Poor risk management creates emotional trauma that can take months or years to overcome. The reality is simple. Trading success is not built through one massive trade. It is built through thousands of disciplined decisions repeated consistently over time. The traders who survive are not the ones chasing excitement or trying to prove how smart they are. They are the ones who respect risk, control emotions, and understand that discipline is the foundation of every successful trading career. Losing a large amount of money in trading does more than damage your account. It damages your confidence, your mindset, and sometimes even your identity. After a major loss, many traders no longer trust themselves. Every decision becomes filled with hesitation and doubt. The charts that once created excitement now create anxiety. And the worst part is that the emotional damage often lasts much longer than the financial damage. Rebuilding confidence after massive losses is one of the hardest challenges in trading because confidence cannot simply be forced. You cannot wake up one morning and pretend the pain never happened. The memory of blowing an account stays with you. It reminds you of the mistakes, the emotional decisions, and the moment everything collapsed. But rebuilding starts the moment you stop running from those mistakes and begin learning from them honestly. Most traders make the mistake of trying to recover emotionally the same way they tried to recover financially, too fast. They rush back into the market desperate to prove they still have what it takes. They increase risk because they want a quick comeback story. But that desperation usually creates another painful cycle of losses. Confidence built on emotion is fragile. Real confidence is built slowly through discipline and consistency. The first step in rebuilding confidence is accepting responsibility. Not blaming the market, not blaming manipulation, not blaming bad luck. Traders grow when they honestly admit where they failed. Maybe the risk was too high. Maybe revenge trading took control. Maybe greed destroyed discipline. Whatever the reason, growth only begins when excuses end. That level of honesty is uncomfortable, but it is necessary. After a major loss, traders must reduce pressure on themselves. This means lowering position sizes dramatically. Small positions may feel insignificant emotionally, especially after trading larger size before, but this is exactly what rebuilds stability. Trading small allows the mind to calm down. It creates room to think clearly again without emotional panic. The goal is no longer making huge profits. The goal is rebuilding trust in your own process. Consistency becomes more important than money during recovery. A trader who follows rules properly for weeks begins rebuilding confidence naturally. Each disciplined decision becomes evidence that improvement is happening. Confidence does not come from one lucky winning trade. It comes from repeatedly doing the right thing under pressure. Another important part of recovery is accepting that losses will still happen. Many traders become emotionally fragile after a big loss because they fear experiencing that pain again. So every small losing trade feels terrifying. But professional traders understand that losing is normal. The objective is not avoiding losses completely. The objective is controlling them so they never become catastrophic. Patience is critical during this stage. Emotional wounds take time to heal. There will be moments where doubt returns. Some traders become too cautious after major losses and hesitate on good opportunities. Others become frustrated because recovery feels slow. But confidence built slowly is far more powerful than confidence built through emotional excitement. Massive losses can either destroy a trader permanently or transform them completely. Many successful traders experience painful failures early in their journey. What separated them from everyone else was their ability to learn, adapt, and rebuild mentally. Pain forced them to become more disciplined, more patient, and more emotionally aware. In the end, rebuilding confidence is not about forgetting the loss. It is about becoming stronger because of it. The traders who survive difficult moments often develop a level of emotional control and discipline they never would have gained without failure. And sometimes the account you blew becomes the lesson that finally changes everything. Professional traders survive and grow because they understand something most people never fully accept. Trading is not about being right all the time. It is about managing risk, controlling emotions, and staying consistent under pressure. The average trader enters the market obsessed with winning. Professionals enter the market focused on survival first. That difference changes everything. Amateur traders often believe professionals possess secret strategies or special market knowledge. In reality, what separates professionals from struggling traders is usually psychological discipline. Professionals know they will lose money regularly. They expect losing trades. They do not panic when losses happen because they understand losses are part of the business. A restaurant owner expects expenses. A professional trader expects drawdowns. The problem is that most beginners enter trading emotionally unprepared for losing. Professional traders think in probabilities, not certainty. They understand no setup is guaranteed no matter how strong it looks. Because of that, they never risk too much on one idea. They know survival matters more than proving themselves right. This is why professionals stay emotionally calm while amateurs experience emotional extremes. Small risk allows professionals to think clearly even during volatility. Another reason professionals survive is patience. Most traders feel the need to constantly trade because they confuse activity with productivity. Professionals do the opposite. They wait. They observe. They understand that forcing trades usually leads to emotional mistakes. Sometimes the best decision is doing nothing at all. That level of patience is difficult because human nature craves action, especially when money is involved. Professionals also understand the importance of routine and structure. They do not randomly wake up and gamble based on emotion. They prepare mentally before trading. They review mistakes. They analyze performance honestly. They follow systems because systems reduce emotional decision-making. The more structure a trader has, the less emotions control behavior. One of the biggest differences between professionals and struggling traders is emotional detachment from money. Beginners stare at profits and losses constantly because every trade feels personal. Professionals focus more on execution than financial outcome. They know if the process is strong, profits will eventually follow. Emotional attachment to money creates fear and greed, which then leads to impulsive decisions. Professional traders are also extremely protective of their mindset. They know emotional exhaustion leads to poor decisions. If they feel frustrated, angry, or mentally unstable, they reduce risk or stop trading entirely. This is difficult for most people because ego wants to keep fighting the market. Professionals understand that sometimes protecting mental capital is just as important as protecting financial capital. Growth in trading also comes from self-awareness. Professionals constantly study their own behavior. They know their weaknesses, emotional triggers, and destructive habits. Many traders spend years studying charts but never study themselves. Yet trading is largely a psychological game. The market exposes impatience, insecurity, ego, fear, and greed every single day. Traders who refuse to work on themselves eventually repeat the same mistakes endlessly. Professionals survive because they accept reality instead of fighting it. They accept uncertainty. They accept losses. They accept that no strategy is perfect. That acceptance creates emotional stability. Amateur traders waste energy trying to avoid discomfort, while professionals learn how to function calmly inside it. In the end, professional trading is not built on excitement or emotional highs. It is built on discipline, patience, and consistency repeated over thousands of trades. The traders who survive long-term are not necessarily the smartest or most talented. They are the ones who learn to remain emotionally controlled while everyone else loses control.